Bloomberg Audio Studios.
Podcasts, radio, news.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Massar and Tim Stenovec from Bloomberg Radio.
Bank of America in particular, reporting that bank traders notching one of their best first quarters on record. The company also reaped the benefits of elevated borrowing costs that pushed net interest income above analyst estimates, but the stock is slumping, and there are good reasons why.
Yeah, that's the good news, Carol. Stock down 3.3% as we speak. Bank of America reporting elevated expenses and charge-offs for soured loans that were higher than analysts expected, failing to satisfy investors with a gain in its trading business. Charge-offs totaling $1.5 billion, up 26% from the last 3 months of 2023. That was more than analysts forecasted.
All right, let's bring in Bloomberg Intelligence Senior Global Banks Analyst Alison Williams here in our Bloomberg Interactive Broker studio. Is it all about the charge-offs? Is that the big bummer?
I mean, I think it's a lot of little things.
Okay.
And I'd also point out that all of banks are selling off. And, banks do not do well in risk-off days. So let's start there. I think the other disappointment is net interest income. That's been the story of the quarter. They did actually have a beat, and they actually showed sequential growth, which was positive versus what analysts had expected and what other banks had expected. But they kept their view steady, just like the other big banks. And so, people are not happy about that. But I do think, let's look at the underlying trends, right? The deposit costs are still going up, but at a slowing pace. And so we think that is positive. And we think it's prudent for these banks to just stay pat. Bank of America is already a little bit more optimistic than other banks. They're calling for a trough second quarter. So it's disappointing that it wasn't fourth quarter. But still more optimistic. Most, if you look at consensus, it thinks like 1Q of next year. But look at how fast things have changed. We've just had the discussion over the last few minutes, right?
Things crazy,
change.
Right?
So if you were bank management, would you be changing your guidance, but so quickly? It really just doesn't, it's not helpful, and it doesn't tend to be rewarding. But, and getting to charge-offs, so you made the point about charge-offs. Credit card charge-offs are always higher in the first quarter. Delinquencies are lower. And if you look at the delinquency trends, they show that pattern should continue to play out. The commercial real estate, I think people might have been taken aback a little bit, especially because Wells Fargo and JP Morgan, who are the bigger lenders, Wells Fargo especially showed improvement in their U.S. office. They showed improvement in multifamily. But what Bank of America said is that they changed their models. They did some revaluations. So maybe it shows that they weren't being as conservative. And so you got that uplift in charge-offs.
Any commentary from management about the strength of the consumer at Bank of America? Because that's they've got a great view into the consumer with all the accounts they have.
They do, and the consumer is still healthy. We keep hearing about the healthy consumer. I think where there's been disappointment is the commercial side of things. So card growth, and then you can argue how healthy it is, right? People are borrowing on their card to spend. But card growth is really, that's the blowout versus that's the only place where you're getting loan growth. And that's why you saw Citi, JP Morgan have the most exposure there. Bank of America has some exposure, so they're doing well, and that business is doing.
Meaning people carrying balances?
Meaning people are carrying balances.
So that's an interesting definition of strength of a consumer, right?
So the spending is healthy,
okay,
right? But so the balances are growing. That's why I said, you can argue, right, that, consumers having the ability to borrow is seen as, well, there's capacity, right? That's a healthy thing. But as they use up that ability, is that really healthy? And if you look at Citigroup, they actually raised their guidance on their private label card, which tends to skew, more towards the lower end of the scale. So it does show that, are there some signs of cracks coming?
Is there a net takeaway for you, Alison, watching all of these big banks, right? It started on Friday and we finished, or, we're kind of getting through it all in terms of the health of the big banks and then what it tells us about kind of the broader business and consumer environment.
So, I think, again, if you back away the guidance, right, the stocks react to the guidance, the cost of deposits, that's showing some stabilization. So that's a good thing. That means that, the impact of higher rates on deposits and people shifting the money around, that's stabilizing. So obviously that could change depending on what happens with rates. We just talked about higher charge-offs and higher charge-offs with the card, but in general, reserve releases across the banks. And that's not, card is forcing to go up, but credit and the provisions are scaling back because the economy is turning out to be better than expected or better than feared, you might say, right? So, and again, that's will evolve,
positive, right? Yeah.
So those things are positive. The cost side is still very inflated. So that's a negative. That's also sort of a knock on Bank of America. And if you have revenue pressure and you have costs going up, bank investors don't like that. Finally, capital markets, we had expected resilience. It was better than we thought. We have a choppy start to this quarter, but that still could be really good for trading. That's a big source of revenue. Investment banking, the other thing that we're looking at, really came in well in the first quarter. A lot of the banks talking about, positive outlook for IPOs. These types of markets are not, they're starting to happen. Some of the performance in the first quarter IPOs is positive. Both JP Morgan and Goldman pointing to that. Morgan Stanley saying, look, these companies, at some point they have to make their decisions and execute regardless of the markets. But I think if we have like a few more, if the few days this turn into more of a sustained trend, it's going to be tough.
Alison Williams of our BI team, and we got the KBW Bank Index down 1.5%.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Charlie mentioned Morgan Stanley shares. They are definitely rallying in today's session in a market where we're kind of little changed overall in the major equity averages. This is coming after Morgan Stanley's first quarter revenue exceeded analyst expectations, helped out by its trading business. That came in at $5.33 billion, cruising past analyst estimates. And also as its wealth management juggernaut also got back on track on that. Remember the news last week, Morgan Stanley downplaying queries into its wealth management clients. That news last week did, as you know, send shares tumbling.
Bank of America also reported, and traders notched one of their best first quarters on record as the company also reaped the benefits of elevated borrowing costs that pushed net interest income above analyst estimates. We should note that all this came after Goldman, JP Morgan, Citi, Wells Fargo, and others, Carol, in the banking sector have reported as well. Bank of America right now down 3.8%.
All right, so we've got a guest who follows the financial sector. Cheryl Pate is back with us. She's Senior Portfolio Manager at the investment management firm Angel Oak Capital. She joins us from Atlanta. She serves as Portfolio Manager for the Financials Income Fund, Financial Strategies Income Term Trust, and the Dynamic Financial Strategies Income Term Trust. So, Cheryl, good to have you here with us. You look at the financial sector, the results that we've gotten from the big banks, and what does it tell you? And not everyone is the same, we know, not all the results were the same, but what were your key takeaways?
Yeah, I think there's a couple things that we're looking at. And I think first off, guidance is critical in today's environment, more so than results generally in terms of how banks are really adjusting to a higher for longer environment and how they're positioned to benefit on an NII side. I think what we've really seen thus far, the reporting season, is that results have generally beat expectations, but it's been largely from the fee income side. So to your earlier commentary, we've seen capital market strength. We've seen, the M&A pipeline has been building. You've seen strength in investment banking and wealth management fees. And then also on the expense side, NII in general, I think has roughly hit the bar, but the forward guidance has been maybe a little disappointing versus buy-side expectations.
What about potential concerns here, as we've heard from the big banks already? Concerns about the consumer, concerns about commercial real estate. What are your takeaways?
Yeah, I think credit has remained remarkably benign. We've been looking for some normalization over the past couple of quarters, certainly. But what we've seen thus far, I think, holds us in good stead. We also got credit card monthly data out yesterday that showed the delinquencies are slowing again for the fifth consecutive month. So we feel generally pretty good about the consumer. There are some pockets on the lower income side, which we have some concerns about, but that's not really showing through in the numbers yet. We've been more concerned clearly on the commercial real estate side, both office and multifamily. I think the takeaway from Wells Fargo, they didn't increase their reserve on the office CRE portfolio. So we do expect there will be bumps along the road, and there's certainly headline risk. But I think that will hit more in the regional bank space relative to the large caps or even the community banks.
So where are the opportunities for you guys, where you look at certainly debt issued by financial institutions? These are your investment opportunities. Where are you seeing the opportunities here?
Yeah, I think we would generally think there's a barbell approach that makes sense in today's environment. We do like the large cap banks from a diversification perspective, more exposure to consumer, but also that fee income, capital markets type business. And then on the smaller end of the spectrum, I think there is value in both community bank equities and debt. What you're really benefiting from here is a very strong deposit franchise, which is a benefit in a higher for longer world. A low cost funding base should help those franchises, which are built on relationship banking. So we see value in both those ends of the spectrum. And I do think the regional banks are likely more challenged here. Again, a little bit more of the office commercial real estate exposure, higher funding costs, and probably a higher regulatory burden coming down the pike. So that's sort of how we think about it across the size spectrum.
Yeah.
I do also think that there is value in the debt side here, where you're seeing equity-like returns for investment-grade debt, given some of the volatility over the last year, which still remains a dislocated market.
I want to push a little bit on the regional banks, as you said, still challenged. What does that mean? Like, give me some ideas. Still challenged meaning we're going to still have some problems. Maybe some regional banks are going to be taken out. They're going to be bought. Like, what does challenge really mean to you?
Yeah, I'm not necessarily calling for a wave of bank failures by any means. I do think there will be a lot of M&A that comes out of the recent events. And when we look for probably more headline risk in terms of some of the commercial real estate exposure could drive M&A activity. We did see a deal announced last night. And so the resurgence of M&A, I think, helps the regional bank space, especially as we're thinking about higher regulatory costs to come, as well as high expenses currently relative, to the large cap banks from a scale perspective. So it's really sort of expenses, potential commercial real estate risk, and higher costs to manage along the way.
Cheryl, we just heard from Fed Chair Jay Powell talking about potentially delaying rate cuts, being higher for longer. And I'm wondering about if, for example, we don't see any rate cuts from the Fed this year, if that changes any part of your thesis, thinking about the financials.
That really benefits the more asset-sensitive institutions, and again, potentially pressures the funding cost side. So that's really when it is important to dissect the funding base of these institutions, how much is in sort of lower cost, consumer sticky checking savings accounts versus higher cost money market CD type accounts. And that's, where you could see higher costs continue to remain a drag from a cost of funding perspective, but higher for longer with a balance sheet that reprices faster on the asset side should actually drive higher NII guidance from a multitude of institutions. So I think that puts most of the sector in a good place.
You guys look at credit like all kinds of iterations, if you will. The moves in private credit, and certainly has been such a big discussion over the last couple of years. What are you seeing in terms of the strain on kind of your traditional financials, your traditional banks, or who have gladly kind of given up playing in the middle market, if you will, when it comes to loans and issuing debt on behalf of some of those middle market corporate clients? I mean, what can you tell us, and what are you seeing in today's environment in terms of moves continuing into the private credit world?
Yeah, I think clearly you are seeing loan growth slowing at the banks. Some of it may be, giving up some share at the margin to private credit. I do think it's a mix of that and also balance sheet optimization. I think capital remains key for the banks, and they are examining all ways to increase capital, whether it be, selling some non-core assets, some loan portfolios, or just slowing growth. I think that will continue to remain a trend. And part of that business has been, moving towards private credit for some time. It's a little bit different underwriting process, standards, et cetera. And so the banks are probably willing to cede that type of portfolio in this environment.
Yeah, it certainly has been the trend. Hey, one last question, because you talked about the large cap banks, fee income and exposure to consumers, that plays in their favor. Do you have when you look at the large cap banks, which we have focused on since they started reporting earnings on Friday, is there a name in the space that in particular you think is a standout?
Yeah, I think the two that we would call as probably the most attractive opportunities, from a large cap perspective, JP Morgan, I think, has, a nice catalyst coming up in their investor day at the end of May. I think guidance, while it was raised at earnings, was a little disappointing, and maybe there's some upside potential there on a higher raise coming out of investor day. And then we like Citi as more of the expense restructuring story, but that continues to show good execution in our opinion.
All right. Really appreciate it. A nice overview of certainly the big banks and really the financials overall, which has certainly been a focal point for investors. Cheryl, thank you so much. Cheryl Pate, she's Senior Portfolio Manager at Angel Oak Capital, joining us from Atlanta.
You're listening to the Bloomberg Businessweek podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
The IMF, by the way, out today inching up its expectations for global economic growth this year, citing strength in the U.S. and some emerging markets, while warning the outlook remains cautious amid persistent inflation and geopolitical risks. And while the world appears to have dodged a downturn, as a story in the upcoming new issue of Bloomberg Businessweek points out, wars and economic nationalism are leaving many countries worse off. This story, as we said, in the new issue of Bloomberg Businessweek.
Yeah, that's out on newsstands later this week. It's already online, though, at Bloomberg.com/Businessweek. And on the Bloomberg terminal. With the details, we bring in a Bloomberg Businessweek Global Economics Editor, Cristina Lindblad. She's joining us here in our Bloomberg studio. So, Cristina, the devil, as they say, is in the details. When you have a 10,000-foot view of the global economy, things look pretty good depending on where you look. But then when you look closer, more on the ground, at least according to this story, there are some parts that are a little bit troubling.
That's right. I think that everyone is breathing a collective sigh of relief that some of the major economies, including the U.S., seem to have dodged a downturn, and the global economy as a whole has. But then when you look beyond that headline figure, even the slight, upgrades to the forecast, you see that, some really troubling stats. Like, for example, 4 out of every 10 people in the world live in a country where the government spends more on paying interest on the debt than on education and health. And so that, from just a human gut instinct, is horrible, right? But also think about how that constrains growth for those nations going forward. So at the IMF meetings this week, I think that collective sigh of relief is quickly sort of being pushed aside to point to the problems that are out there.
Debt, no doubt, a problem. And I think about years ago, right, when we used to just talk about the U.S. debt all the time and servicing the debt and how could we do it. And in a higher rate environment, it becomes much more problematic, whether it's for the U.S. or other nations. The other thing I think about is geopolitics, right? And, we saw that certainly this weekend. We are seeing new alliances geopolitically. And you do wonder, Cristina, how that plays out economically as well.
Right. So besides, real shooting wars, we also have what I think may be a new front opening in this trade wars that the U.S. is leading the fight on, with Europe also, joining. And we saw Yellen coming back from her trip to China last week, already calling attention to the fact that China has this overproduction problem, as we're calling it. And, the German chancellor is in China this week, echoing the same kinds of ideas. So I think that we may expect to see new barriers coming into the U.S. Against, EVs, Chinese EVs, which already face actually pretty big obstacles getting into the U.S. market, but also like solar panels and things like that. Areas where the U.S. is investing lots of money to ramp up, capacity, manufacturing capacity here.
Cristina, the story also brings up a part of the immigration conversation that I think does not get included when people talk a lot about migration. And that's the idea of what actually pushes people to move to different countries. And the idea that if life is not good in parts of sub-Saharan Africa or parts of Latin America or parts of South America, that spurs people to move to different parts of the world. Talk a little bit about that and how in some of these countries, we could see even more migration, more emigration from these countries into other countries as a result of issues within the countries.
Well, that's right. I mean, there are many what people call push factors to immigration, and the lack of opportunity at home is one of them. And that lack of opportunity isn't going to improve if governments are not able to invest in human capital, which is like health and education. And also, climate change is another driver. We're seeing that in Central America and these parts of the region called the dry corridor, where a lot of, farmers have been forced out and are seeking, jobs in the U.S. So basically, I think the immigration topic is one that sort of kind of brings our focus to why we all need to be concerned about these problems that are far from our shores.
The other thing I think about is too, like the technology race, and we talk about it all the time that's going on. And you do think about, again, you're seeing just like in geopolitics or politics, you're seeing new alliances made, and we're seeing that in the same thing with technology. And you do wonder how that ultimately widens the gap between either developed nations versus the developing world. Give us the bigger picture of what's been happening pre-pandemic in terms of closing the gap, if you will, between individuals.
There was a clear trend before of a convergence between developed and developing countries. So people felt good about that, about kind of like, okay, we see progress, we see standards of living, moving up. We saw tremendous poverty reductions in the 3 decades leading into the pandemic. But in 2022, there were 23 million more people that lived in extreme poverty than before the start of the pandemic. So some of the trends that we're seeing now in terms of this sort of fragmenting that, is one of the things people call it, it risks leaving some countries left out of technological development because the U.S. and China, the frictions that are playing out, there's a lot more sort of the push is because of national interest, not sharing technology with other countries, using subsidies to bring more investment into your own country. So that's going to penalize other countries. Maybe at the beginning it'll be already, we saw last year, for example, with EVs, some European car makers were choosing to put their factories in the U.S. rather than add new ones in Europe. Mm-hmm. Well, that's going to also affect other countries, that are less developed, and and could stunt growth, frankly.
Yeah. So where do you, I don't know, when you guys, this is what you do, you track the global economy, what people are saying. Wall Street, you guys get into some of the expectations. What are we hearing from Wall Street analysts? Are they starting to kind of ratchet down, or some of the global analysis in terms of expectations for global growth, despite what the IMF says? Wall
Street is still very fully engaged with the AI narrative. I don't really think, between, the Fed watching and the AI, exuberance, I don't really see that this is tempering expectations so much, and in major growth markets. Yeah,
it does seem like this part of the conversation, Carol, is lost to a lot of people.
Like when you start breaking it down.
Yeah, when you start breaking it down, I think Absolutely. This is not necessarily on a lot of people's radar in terms of how they're thinking about global growth.
No, because I think especially in the U.S., we have been really lucky. There have been downturns in parts of Europe, right? So. Yeah, I think it's always been kind of a risk of these other stories not pushing out, to be heard and stuff. But I think that now we really do, because of this divergence, you really risk not this story not falling off the radar literally.
Well, you can read the whole story. It's in the upcoming new issue of Bloomberg Businessweek. You can also find it already online at bloomberg.com/businessweek, and of course on the Bloomberg terminal. Cristina, thank you so much. Cristina Lindblad, she's Global Economics Editor here at Bloomberg Businessweek.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
We've been talking a lot about the yield curve. And right now, again, just reiterating some of those numbers. 10-year note off its highs of the day. We did, but right now we're at 467. That 2-year note, which went above 5% today. Right now, Tim, just below it at 497.
Probably a good time to talk to Jimmy Lee because he says that investors have become more comfortable about interest rates staying higher for longer, assuming it's due to the economy staying strong. And that's kind of, Carol, what we heard from Jay Powell today.
Yeah, right. That's the caveat. This is, of course, coming at an interesting time where we try to figure out what happens for the rest of the year when it comes to Fed rate moves. Let's get to Jimmy Lee, as you said, setting him up so well. Founder and CEO at Wealth Consulting Group, back with us from Vegas. So, Jimmy, you do say investors have become more comfortable about interest rates staying higher for longer. It is, though, the caveat, the big caveat, that the U.S. economy stays strong. Looks like the case right now. So walk us through your thinking and what could possibly go wrong.
Good afternoon, Carol and Tim. I think that investors have gotten comfortable with higher rates. Obviously, margins have been good enough for companies to produce good earnings over the last few quarters, and earnings estimates have gone up over the last few months. So I think so far everybody's positive, but what's on everybody's mind today is this pullback that we've gotten because yields have gone up because of the inflation data that we've seen recently. But I would have expected that a 10% in first quarter. While I liked it and our clients love it, we needed a little bit of a pullback. And, I wish it wasn't due to inflation data being hotter than expected. But, we're really talking about 0.1 of 1% higher last month, right, on some of the numbers that has caused all the friction here. And I agree that it hasn't, the trend isn't lower right now, but I'm contrarian a little bit, thinking that inflation data might look better, down the road. I've been saying that for a while and I've been wrong. But I hope that's the case and that the Fed does get to cut sooner than later. And today's Powell speech really didn't, tell people that that's what he was thinking, and then trying to get people more comfortable with the idea that the Fed's going to keep interest rates higher for longer.
You sound hesitant. You sound a little tentative.
Well, I actually believe that inflation is coming down, and there's certain areas that have been really difficult for inflation, including housing, that comes in month after month, being a big portion of why inflation continues to look so bad in some cases. But then, you have to look at everything in relatively speaking, and it's still headed in the right direction. So what Powell did say today is he still believes the base case is that inflation is coming down. And I don't think that the Fed's going to raise rates like some people are thinking. I do believe we're going to get some cuts. I'm not sure how many at this point, but if inflation data does come in better in the second half of the year, then I think that the Fed wants to cut sooner than right before the election.
Hey, Jimmy, I'm just pulling up on the terminal here, doing some quick calculations. We're down from all-time highs on the S&P 500 by a mere 3.6%. So to put into context the sell-off that we've seen just in the last week or so, is this a buying opportunity yet for you and your clients?
I do believe, Tim, that we could get some more selling, but yes, if you have fresh cash, I think these dips are opportunities to get in the market. And I think that at the end of the year, I think we'll end up higher than we're at today. The biggest part of trying to time the market correctly that's difficult is that 75% of the time, historically speaking, stocks are higher 12 months later. And so it's very difficult to short. And for most investors that are, normal Americans trying to save for retirement and to stay retired and not run out of money, investing for the long term, you don't want to try to get in and out of the markets. I don't think that's a good strategy, but relying more on financial planning strategies of making sure that you have enough money sitting in a bucket that's not going down ever due to a stock market. If you need the money for living expenses or other purchases, then those are the kind of ideas that we like to have clients employ, not trying to time the market.
I know, of course, not trying to time the market, but if you say there could be some more selling ahead, what could prompt that more selling? Just fresh inflation data or fresh economic data that continues to show we're in a hot economy?
Well, in the short run, certainly, probably the inflation data is the biggest variable, but geopolitical risk is another one. And so if the situation in Iran and Israel escalates to an issue that could cause a lot of short-term selling, I think that's very possible. We hope that doesn't happen and things settle down so that, lives are not lost, that don't need to be lost. But we don't want that to escalate. And so geopolitical risk has been on the top of my list all year long, along with stickier inflation data. And certainly what's going on over there is not helping oil prices, which, I filled up the tank yesterday in my big truck, and it was a lot of gas and a lot of money. And so I know a lot of people are facing that today. But I think, if interest rates do come down, I think it will help with a lot of the activity in certain areas of the market, including housing. There'll be more inventory, and more supply for people to be able to purchase. And we need lower rates, though, so that mortgage rates are lower and people want to, move in and out of their houses like normal.
Hey, Jimmy, we talk about EVs all the time, so I got to ask, in Las Vegas, you have a big truck. Why are you still driving internal combustion engine and not like a, Rivian or F-150 Lightning or something?
You know what? I still like my cars a little bit more traditional. And, I do have a truck out of one of the vehicles that I own. And so at some point, that might turn into more of a EV type hybrid vehicle. Who knows? But not at this point right now.
Yeah, I mean, Tesla is one of the worst performers in the S&P 500 today, down almost 40%, Carol, so far this year. Another down day for the company. And one of the things we talk about all the time is people making their choice for the next vehicle, not necessarily being an EV, but being a traditional ICE vehicle.
Right. Remember, we've talked about hybrids are much more, have been in demand as of late. So interesting. Hey, listen, just 30 seconds, Jimmy. If you had new money to commit in this market, where would you put it? Would you maybe look at the Treasury trade, especially when we've seen rates move up here?
Carol, absolutely. So
Yeah.
I think that if you're a bond investor, having more duration right now is not a bad idea, even though rates could go higher. And in the short run, you could lose a little bit of net asset value in that way, but maybe dollar cost averaging into longer dated bonds. And I think investors should be set up in more cyclical sectors, getting prepared for a lower rate environment, even though we're not there yet. I think you need to get ahead of it. I think that the potential trade in things like real estate could happen very fast, and you could have a big bounce back in interest sensitive stocks and sectors.
All right. So appreciate it, as always. Jimmy Lee, founder and chief executive officer at Wealth Consulting Group, joining us from Las Vegas.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.